This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on gaps. I want to begin by what I mean when I talk about a gap. I use a very broad definition. For me, a gap is a space. It's a space between the current price and any support or resistance. For example, support or resistance, it can be the high, low, open, or close of any bar, the current bar or prior bars, any moving average, trend lines, trend channel lines, and a lot of times the support or resistance can be minor, yet it turns out that the gap is important. At the close of this bar, there's space between its high and a prior high, its high and the high of this lower high, and of the high of the prior bar. Those are all gaps. For example, this is a gap between this close and that high. The close of this bar is slightly above the high of this bar, a gap between this close and these highs as well. The low of this bar did not fall below the high of this bar, and therefore there's a gap here. Here's a moving average. It doesn't matter what moving average. There's a space between the low of this bar and the moving average. That is therefore a gap. There's a space between the low of this bar and that high, so that's a gap. There's a space between this low and that high, and therefore another gap. Look at the open of this bar and the close of the prior bar. This open is slightly above that close, and therefore there's a gap. Exhaustion gap, a big trend bar late in a bull trend. Usually the gap will close. The gap between the close of the big bull trend bar, which will end up as the exhaustion bar, and the high of the prior bar. And you can see we traded down below that high. It closed the gap, and that made this bar an exhaustion gap bar. Exhaustion gap does not mean trend reversal. It just means the bulls are exhausted, and they usually wait a few bars before buying again, which they did. This is a buy signal bar, and the bulls bought. This is a test of that buy signal bar high, and there's a gap between the low of this bar and the high of that bar. I want to talk a little bit about traditional gaps. For example, this is a daily chart. Does not matter what market, but it's a daily chart. You can see that the low of this big bull trend bar did not fall above the high of the prior bar. That is a traditional gap between the low of a bar and the high of the prior bar. That's a gap up. A gap down is a space between the low of a bar and the high of a bar right here. A gap up is a sign of strong bulls. Here's a gap down, and it's a sign of strong bears. The market actually opened down here, rallied strongly. It was unable to get back above yesterday's low, and then sold off to a new low later in the day. And this is the gap down. On daily charts, gaps are common. These green boxes are gaps up, and then the red boxes are gaps down. They usually do not have much significance. They're less common on weekly charts and extremely uncommon on monthly charts, except very thinly traded markets. And they're also less common on Forex charts, although you sometimes see gaps on the Forex charts as well. On 5-minute charts of very liquid markets, markets that have a lot of volume, gaps are rare. Gaps on the daily charts of stocks are especially common in trading ranges, and they're usually meaningless in trading ranges. They do not have any predictive value. Most breakouts in trading ranges ultimately reverse, and therefore a gap in a trading range has no predictive value. We have a gap up, a gap down, a gap up, a gap up again. Has no predictive value. They're meaningless. Again, a daily chart. We're rallying, and then the next day, the low stayed above the high of this bar, and it's after a bear trend. This is therefore called a breakaway gap or a breakout gap. You know in hindsight that that's what it is. If you have a trend up after a gap like that, you look back and say, oh, that's a breakaway gap, the start of a bull trend, a gap up early in a bull trend. At the time it happens, you think it might be that way, but we're still in a trading range, and we have lots of gaps in a trading range, and this could easily quickly reverse within a day or two or three, and then be just a meaningless other gap in the trading range like all of these other gaps were. We sold off. We have a gap down. We have a gap down. Whenever you have gaps, you're always going to be thinking that they could lead to measured moves. Only in hindsight do you know that this was a measuring gap. When you see the market reverse up at just about a perfect measured move target, you know this was a measuring gap. At the time it happened, you wondered if it might be a measuring gap. Here we have a double top with this high and a reversal down. That means the gap is important, and maybe it'll fall for a measured move. And when it got down to the measured move target, the bulls bought to get long, higher low, major trend reversal, bear trend, bull breakout, higher low. And the bears bought to buy back their shorts. When you have a gap late in a trend, it often closes, as it did here. This went above the low of that bar. And then traders would call it an exhaustion gap. At the time that it happened, you did not know if it was going to be a measuring gap leading to a measured move down. It pretty much did. From here to here, it's almost a measured move down. Once it closes, traders begin to wonder if it's an exhaustion move. This final gap was the last move by the bears before the bear trend ended and converted into a trading range. And then here we have a gap up. This was the start of a rally. You could also call this entire thing an island bottom. We have a gap down, a trading range, and then an island top. Traditional island tops and bottoms, there's no trading that takes place between the two. Here we traded repeatedly around this gap. In my mind, we sold off, we rallied strongly. This is a reversal. We had a gap down at the end of the sell-off, a gap up at the beginning of the rally. I would call all of this an island bottom, even though it's not a conventional island bottom. This is a conventional island bottom, where you have a gap down and a gap up, and there's no trading in between. Once the market moves above the top of the gap and the gap is late in a trend, traders would call this a closed gap, and they would call it an exhaustion gap. Lots of other gaps are common, and especially in trading ranges, and traders call them gaps or common gaps. On this slide, I'm talking about the traditional definitions of gaps. As I said on the prior slide, I have a much broader definition of a gap, and mine, I think, is much better for traders. I mentioned island tops and bottoms. If the market gaps up and then gaps down, it's an island top. Traditional trading, you want the two gaps to be at the same level, and you don't want any trading taking place in the gap up before you get the gap down. But for me, if it gaps up and then down, it's an island top. This is a bigger island top, gap up and gap down. We gapped down again, and gapped up. This is an island bottom. If you want, you can call these two bars as an island bottom. Island bottoms sometimes lead to big trends. Here we get an island top and a big sell-off, an island bottom and a big rally. But most gaps are meaningless. Does it matter that this is an island bottom or that this is an island top? No, it's simply a reversal, and it's no more important than any other reversal. When you see it happening, you're wondering if it's the start of a swing, Here, you wonder if it's the start of a trend up, but you don't know until after you get a series of strong bull bars. And at this point, you don't care if there are gaps or just 2 or 3 big bull bars. You know the market's reversing up. So the gap really adds nothing to what you're doing as a trader. It's simply a reversal. We sold off, we rallied. The market's reversing, and therefore traders are looking to buy. Some charts rarely have gaps. When that's the case, you look at every reversal as a variation of an island top or bottom. It does not matter that we have a gap down, another gap down, a gap up. All that matters is the market went down and now it went up, whether or not there are gaps. Most reversals fail, and therefore most island bottoms and most island tops do not lead to trends. Here we have an island bottom, and you can see we closed the gap over here, and therefore the island bottom failed. I mentioned that the gaps do not have to be at exactly the same level if you're talking about islands, although a lot of the textbooks will say that the gaps have to be exactly the same level. Here we have a gap up and a gap down. To me, this is an island top. I don't care that this gap is far below that gap. Here, this is more of a traditional gap. We have a gap down and a gap up, and there's a space. You can draw a line right between the two gaps, and there's no trading taking place. This is a traditional island bottom. It's no more important than any other type of island top or island bottom, and you can see it resulted in a trading range and not a bull trend. For me, island bottom, we have a gap down, a gap up. When I see that, I think that this could be the start of a bull trend, and it makes me get ready to buy if I have not bought already. But again, it's no more important than any big reversal, whether or not there is a gap. A 2-bar island bottom, you can also call this whole thing an island bottom. Gap down, and then gap up or gap up. So island bottom with these two gaps, island bottom with this gap and that gap, island bottom with this gap down and that gap up. An island can be a single bar, or it could be 10, 20, 30, 40, 50 bars. For example, we gapped down, we gapped up. This is an island bottom. It resulted in a trading range. This entire thing I mentioned earlier is an island bottom. We have a gap down at the end of a trend, an exhaustion gap. We have a gap up here, and it led to a bull trend. And therefore, I would call this whole thing an island bottom. I would not consider that particularly important. What's more important to me is we sold off, we reversed up. It's a reversal. I don't need to know that it's an island bottom for me to want to buy. A lot of times when you have island bottoms and tops, there are many gaps to look at and many ways to draw them. For example, this whole thing is an island bottom, but within it there are other island tops and island bottoms. I said that I don't care if there's an island top or an island bottom or an exhaustion gap or a breakout gap. All I care about is momentum. For me, every trend bar is a breakout. Every trend bar is a gap, even though you don't see an actual space. Every trend bar is a climax. Here, I talked about this. There's a gap between this close and that low, a gap between this close and any of these lows, a gap between this close and that low. Those are all gaps. Here, there's a gap between this low and that high. This low tested this high, so it tested the gap. Here, we have a very strong series of bull bars. In my mind, it's no different from 10 bull bars with a lot of gaps in it or 1 bull bar with no gaps. Any bull bar, any series of bull bars is a breakout. It's a climax, and it's a gap. Gap between this close and this high. Gap between this close and this high. Gap between this close and that high. strong bull breakout, every bull trend bar, every series of bull trend bars, I think of exactly the same as I do a gap. It's also a breakout. It's also a climax. But a climax can go a long way before there's a pause. A buy climax, and it turned out to be the end of a swing up. We traded down for about 40 bars. We have a big bear reversal, breaking below the bottom of this channel, a wedge, 1, 2, 3. It's a trend bar, and therefore it's a breakout. And there's usually a gap associated with it if it's the start of a bear trend. For example, a gap between the close of this bar and the low of that bar, a gap between the high of this pullback bar and the low of that bar. Sometimes you get these really small gaps. For example, the close of this bar and the high of that bar. If you're not familiar with these things, it's easy to ignore them, but they're important, especially if you get several of them. They're a sign of strong bulls. Big bear breakout below this low, below all of these lows, but immediately reversed up. The gap between this close and that low closed over here, and therefore this bear breakout, this bear trend bar, is also an exhaustion gap. We have a bull breakout here. The low of this bar is above the high of these bars. There's a gap. Therefore, traders will look at the bottom of the gap for a possible measured move up, and they'll look to take profits around the measured move target. This theoretically could have been a double top. We could have rallied here and sold off. I look at it as a potential double top. If it did reverse down, traders will look at the neckline for a measured move down. Just like the height of this would have led to a measured move down because of a double top, if we break above it, I look for a measured move up based upon the height of this sell-off. Every gap is a trend bar. Every trend bar is a gap. This is the E-mini chart. It gapped up on the open. This is the cash index 1-minute chart. Cash index often does not have gaps. If you're looking at the cash index, you'd say, wow, that's a pretty big 2-bar breakout. However, if you're trading the futures contract, you have a big gap opening. And to me, it's the same. I don't care if it's 2 big trend bars. I don't care if it's a gap. They're the same. It's a quick move up. The market's deciding that the price is wrong and it has to go up quickly. Whether there's a gap or a trend bar or a series of trend bars, it doesn't matter. They're telling me the same thing. The market wants to go higher. This is the gap opening on the 1-minute futures chart. And then this is the big bull trend bar on the cash index chart. This is the euro versus the dollar 5-minute chart. And this is the FXE. It's an ETF that tracks the euro. And you can see they're doing basically the same thing. One big difference is we have gaps on this chart. At the time I made this chart, the volume was not particularly heavy in the FXE. And whenever a chart does not have a lot of volume, it tends to have a lot of gaps. This gap down corresponds to this bear bar. This gap down corresponds to this bear bar. We have a gap down here and a bear bar. That gap and bear bar corresponds to this bear bar. If I'm just looking at the euro, I'm not seeing the gaps. If I'm just looking at the FXE, I'm seeing gaps, and they mean exactly the same thing. Whether or not you see gaps or whether you simply see trend bars, a trend bar is a gap is a trend bar, and I trade them exactly the same way. We have a very big bull trend bar closing far above the high of the prior bar and far above the high of the past 20 or 30 bars. Therefore, there's an increased chance that it's the start of a bull trend. There's a gap between this close and this high, that high, and this high. It's probably a breakout gap, and it's probably also a measuring gap. The low of this bar stayed above this high and above that high. This space is probably going to lead to a measured move up from this low to this high, and the market will probably go up for a measured move. A breakout bar, you can call it a bull breakout, you can call it a gap because there's a gap between this close and these highs. When the bar is big like this and it closes far above a lot of bars to the left and it closes near its high, it's more likely going to be the start of a move up. Chances are the move up will have at least two legs. Bulls will buy the first pullback, and the bears who sold, hoping the breakout would fail, will use the first pullback to buy back their shorts for a loss. A breakout bar, a gap bar, has a higher probability of leading to a trend up if it closes above a lot of resistance. For example, if there was a big bear trend line coming down here, closing far above a lot of prior highs, that is significant. That increases the chances that you're going to get follow-through buying. Gaps between this close and the high of the bar before it and above any of the prior highs. Those are all gaps. This close is above that high, and therefore this is a gap as well, another sign of strong bulls. I would call these two bull bars a breakout, a two-bar bull breakout. If you want, you can also call it a gap. This bull bar became a measuring gap, although you cannot see it on this chart. The odds are high that we got a measured move up from this low to right around here, the middle of that bull bar. We have a breakout, the start of a bear trend. A bear breakout. This close is a little bit below that low, maybe not, maybe around the same price as a tail. But here we have a bigger bear bar closing on its low or near its low and well below the low of this bar. These three bear bars reversed this rally. We're getting a bear reversal. And three consecutive bear bars closing below their midpoints, one closing on its low, two having good bear bodies. We're probably going lower. There's a bull trend line here, and we're breaking below the bull trend line. The bigger the bar is, the more it closes on its low. The more bars to the left it closes below, the more likely we're going to go lower. It closed below the trend line, so there's a gap between its close and the trend line, a gap between its close and the low of the prior bar. Gap here, and then we have an even bigger bear breakout, and there's a gap between its close, the low of the prior bar, its close, this low, its close, that low. We have a 4-bar bear breakout. If you want, you can call it a gap, you can call it a breakout, you can call it a reversal. Strong enough momentum so that there's going to be at least a second leg down. Two big bear bars closing on or near their lows, breaking far below the trend line. You could call these two bars alone a breakout or a gap. At a minimum, traders will look for a measured move based upon the open of the first bar of the breakout to the close of the final bar of the breakout. Here it's a 2-bar breakout. The market's probably going to fall for a measured move from this open to that close, so somewhere down here. We have a breakout, a close well above this high, a very big bull bar closing on its high. The bears tried to get a reversal, but this low stayed above the breakout point. We have a gap and then a bull close. It looks like we're going higher. We're probably going up for a measured move. Maybe simply from this low to that high, probably from the start of the bull trend to that high. This is probably the middle of a move, and bulls will look to take partial profits at around a measured move up. The measured move can be from this low to this high, or from this low to the middle of that gap. You don't know in advance. This gap is very small, so the target would be about the same, whichever price you use for your measured move up. This would be the target. And you can see when the market got there, bulls started to take profits. This tail means bulls started to take profits right below the target. and then here they clearly took partial or full profits. When you see a gap like this and you see it get tested and you see the market starting to reverse up, it's probably going to reach the measured move target, so traders will look to buy and then take partial profits or full profits at the target. Big bear bar closing on its low, closing below the low of the past prior bars, possible measuring gap. The bulls tried to reverse the bear breakout, but failed. We closed down below the midpoint of this bar, so we have a bear follow-through bar that increases the chances that we're going lower. It also increases the chances that this will be a measuring gap between this high and that low. Traders will look for a measured move down from the top of the bear trend here to the top of the gap here, or from the middle of the gap here. The gap in this case is the high of this bar and the low of that bar, but it could be the high of a bar 2 or 3 bars later, or the low of a bar 2 or 3 bars, or even 5 or 10 bars earlier. Top of the bear trend, the middle of the gap, this would be a measured move target. Some computers will use this low, and the target would be a little bit higher. Bears sold and took profits around the measured move projection. Every bull trend bar is a gap. If you get a big bull trend bar late in a bull trend, usually 20 or 30 bars into the bull trend, but sometimes as early as 10 bars into the bull trend, you have to wonder if it's an exhaustive end of the trend instead of a measuring gap and the start of a strong leg up. At this point, we have a gap, this low, that high. This might be a measuring gap. It's not a particularly big bar, but it still could lead to a measured move up. However, we're 10 bars into the trend is not all that strong. You have to be thinking that it's possible the gap will close and the bull trend will end, and the market will enter a trading range or possibly even a bear trend. The gap is between two prices, the low of this bar, which is the low of the pullback bar, and the high of this bar, which is the breakout point, and the gap is the space in between. The bottom of the bull trend is here. Traders will look for a measured move up, either based upon the middle of the gap or from the high of this bar. They'll look to take profits around a measured move up. We have a bull bar closing above the high of this bar, and therefore it's a gap. But now we're 30 bars into a bull trend, and we're near a measured move target. This is more likely going to be an exhaustion gap, and it will close. More likely to be an exhaustion gap than another measuring gap. And you can see the gap close a couple bars later. The bull trend ended and converted into a trading range. It might resume again, but a gap, a big bull trend bar, in fact, the biggest bull trend bar in probably 20 bars, usually is an exhaustive end of the trend and not the start of a new leg up. Euro versus the dollar, 5-minute chart. This is the biggest bear trend in the trend, and it's occurring 40 or 50 bars into the trend. It could be a measuring gap in the middle of a bear trend, but whenever you get the biggest bear trend bar occurring 20, 30, 40 bars into a trend, you got to be thinking that it might be an exhaustive end of the trend and not the start of an even stronger leg down. When this bar closed, there are many ways to look at the gap, maybe from the close of this bar to any of these lows, certainly to this breakout point. And here, for the bears, they're hoping this is a pullback and the bear trend will continue down. The bulls are hoping that it's a failed bear breakout and that this becomes an exhaustion gap and that the market rallies and closes the gap. Usually it tries to get at least a little bit above the top of the final sell climax. The middle of the gap is here, possibly a measured move down from the middle of the gap, possibly a measured move down from this high to that low. We're already at that target. If it reaches one target, then you look for another, for example, the middle of the gap. Even though it's the biggest bear trend bar, 30 or 40 bars into a bear trend, it ended up as a measuring gap. And you can see when the market got down to the measured move, traders took profits. The bulls were not able to get the market to go above that bull bar. The probability after you see a very big bear bar and a bear follow-through bar, the probability is you're going to get at least a small second leg down, possibly a measured move down. Another big bear bar occurring about 15 or 20 bars after this one. Another follow-through bar, gaps from this close to that low and this low and this low, all breakout points. But the gaps ultimately closed, and this was an exhaustion gap late in a bear trend. An exhaustive sell climax does not mean a reversal into a bull trend. Most of the time, it means conversion into a trading range. It might ultimately reverse, but usually an exhaustion move means the bears are exhausted and they'll stop selling as aggressively and the market stops going down, not necessarily reverses into a bull trend. Once the gap closed, it became an exhaustion gap. I use the term gap differently from just about anyone else. I use it in a way that's useful for traders. A gap is simply the space between the current price and some support or resistance. Most gaps don't mean much, but there are a lot of gaps that I'll talk about in the next several videos that most traders are not even aware are gaps, yet they have predictive value. They help let you know if there's good selling pressure and the market's going lower, if there's good buying pressure and the market's going higher. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on gaps. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on gaps. I'm going to be talking about 2 special types of gaps today. The first is a moving average gap bar, and the second is an exhaustion gap. Here are a pair of moving average gap bars. There's a gap between the high of the bar and the moving average, and then another bar with a gap between the high and the moving average. And they are occurring in a bull trend. Whenever you have a bull trend that lasts 20 or more bars, and then you finally get a bar or 2 or 3 or 5 bars that are completely below the moving average, there is a gap between the high of the bar and the moving average. These bars are then moving average gap bars. It's a bull trend. The first time the bears do anything, they usually fail. The first time they get a bear bar, usually the market goes higher. The first time they get a big bear bar, the market usually goes higher. The first time they get a close below the moving average, the reversal attempt fails and the market usually goes higher. And finally, when they're strong enough to put a bar or a series of bars below the moving average, that reversal attempt usually fails. Even though it's a sign of very strong bears, they're strong enough to put bars completely below the average price. The odds are it's going to fail and the bull trend will resume. But having bars completely below the moving average means the bears are pretty strong. That means that there's a 40% chance once the bull trend resumes, the bears will be able to get a major trend reversal into a swing down. Most of the time, when you get gap bars late in a bull trend, 20 or more bars into a bull trend, you get an attempt at a major trend reversal after the bull trend resumes. For example, a lower high major trend reversal, a double top, or a higher high major trend reversal. Gap between the high of those 2 bars and the moving average. This is a bull trend that's been going on for about 40 bars. It finally touched the moving average. There's a gap between the low of this bar and the moving average, a gap between all of these bars and the moving average. When you finally get a touch of the moving average, it's a 20 gap bar buy setup. If a bull trend has been above the moving average for 20 more bars, there are usually bull scalpers buying at the moving average, looking for at least a test of the prior high. Here we have a lower high, a minor reversal. The pattern is too small to be a major reversal. Probably going to be a minor reversal down, which means a leg in a trading range, 2 legs down, 1 pull by 2. And look at this bar. There's a gap between its high and the moving average. It's a 20 gap bar. It's occurring in a bull trend that has lasted more than 20 bars. The odds are it's going to lead to a resumption of the bull trend or a trading range. In either case, the odds are it's going to test up. Once it tests up, it's probably going to form an attempt at a major trend reversal. If it does, like all major trend reversals, there will be a 40% chance that the bears will get a swing down. A sign of strong bears, and therefore the bull trend might be transitioning into a trading range, and it might be preparing to transition into a bear trend. A gap bar and a bull trend, it usually leads to the final leg of the bull trend before the bears create an attempt at a major trend reversal. Here the rally went on for a long time. Usually if the rally goes on 20 or more bars, traders start to look again for another topping pattern. Here we have a final bull flag and a reversal up and down. It's also, if you want, a wedge top, 1, 2, 3. Is it a higher high major trend reversal? Probably not on this time frame. Once the rally resumes for 20 or more bars, traders start to look for another topping pattern. Maybe on a higher time frame chart, it's a higher high major trend reversal. But for the sake of argument, let's just call it a higher high major trend reversal. The bears get the reversal, and at this point, they have a 40% chance of a swing down, which they got. They have a 60% chance of either a trading range or a bull flag and a resumption of the bull trend. Here we have a triangle for a final bull flag. A triangle late in a bull trend, 20 or more bars into a bull trend, usually becomes the final flag, and the market usually reverses and then either enters a trading range or has a swing down. We also have a wedge top, and then we have a consecutive top. We have a failed breakout above a triangle. So we have consecutive tops, a wedge top, the bulls broke above it, the breakout failed, and now we have a second top. That has a higher probability of leading to a swing down. This gap bar was warning us that the bull trend may not last much longer before the bears have a significant swing down, as they did here. Strong bull trend above the moving average for a lot of bars. When it finally hit the moving average after 20 or more bars, bulls bought it. We have a higher high here. Not enough bars for a major reversal, only 4 or 5 bars down, 5 bars up. Probably a minor reversal, which means the sell-off is probably going to be either a bull flag, like a double bottom bull flag, or a trading range. However, we have 4 bars where there are gaps between the highs of the bars and the moving average. If the bull trend does resume, the resumption will probably attempt to form a major trend reversal. And here we have a lower high major trend reversal, probably not enough bars for a major reversal, and therefore a minor reversal into a bull flag or a trading range is still more likely. However, you have to be prepared for a major reversal. We have gap bars, we have a rally to a lower high. We have another series of gap bars, again, signs that the bears are getting stronger, and that reduces the chances that this bull trend will last a lot longer. It increases the chances that the bears will get a major trend reversal attempt and a 40% chance of a major trend reversal into a bear trend. bull trend resumed, but weak. We have bear bars, we have a failed breakout above this lower high, and therefore it's a type of higher high double top, and it's a major trend reversal. This was a minor reversal. Very often when you have an attempt at a major trend reversal and it does not look right, too many bull bars or not enough bars in the legs, the market tries to get a double top lower high major trend reversal, which it did here, and this has a higher probability of leading to a major reversal than this. But like all major trend reversals, it still only has a 40% chance of a bear swing, which ultimately formed here. I'm now going to talk about gap bars in a bear trend. You can see a bear trend lasting 20 or more bars, a bull breakout, and we have a couple bars that are completely above the moving average, a gap between this low and the moving average. The bulls are getting strong. They're strong enough to put bars completely above the moving average. When that happens and the bear trend resumes, the odds are 60% the bulls will try to create a major trend reversal. And if they do, they have a 40% chance of actually getting a bull trend. 60% chance the major trend reversal will result in either a trading range or a bear flag. A pair of gap bars completely above the moving average. Bear trend lasting 30 or more bars. And look at this, we have a bar completely above the moving average. There's a gap between its low and the moving average. 60% chance the bear trend will resume and attempt to form a major trend reversal. We got a lower low and we're trying to reverse up. 60% chance the bears will get a major trend reversal attempt after a gap bar in a bear trend. 40% chance the major trend reversal will lead to a bull trend. 60% chance the major trend reversal will lead to another bear flag and another leg down or a trading range. Bulls finally strong enough to put a bar completely above the moving average. That's a sign that the bulls are getting stronger and the bears are getting weaker, and therefore this bear trend might soon transition into a trading range or possibly even a bull trend. Lower low major trend reversal, but a tight bear channel with a lot of bear bars. Here we have about 7 bars without a bull body. Usually that's not going to lead to a bull trend. Usually the market will need some kind of a double bottom with this low. And here we got one more leg down. If you want, you can call it a double bottom or a lower low double bottom. This is a double bottom. This low is below that low. It's also a lower low major trend reversal. Bear trend bull breakout with good buying pressure, strong enough to get a moving average gap bar, and then a couple legs down to a lower low. If you want, you can look at this and say, well, this is a lot of bars down. Maybe it's a trend resumption down, and maybe we should call it something else, like a wedge bottom, which it is. However, despite all of these bars down, a lot of traders will look at it as a lower low major trend reversal. Here's the bear low. We have a gap bar and then a two-legged move down to a lower low. We have a bull IOI. That's a buy setup, or traders would buy above the pullback here or above this double bottom bull flag. Double bottom in a new bull trend and a bull buy signal bar. I want to talk now about exhaustion gaps. Big bars occurring late in trends often lead to an end of the trend, and that means either a pause and a bull flag or possibly a trading range, and sometimes even an opposite trend. What I'm looking for is a rally that has gone on for 10 or more bars, and then I need bull bars closing at or near their highs, certainly above the midpoint, and it's often a series of 2 or 3 bull bars instead of a single bull bar. There are many ways to draw gaps here. This close to this high or that high. And then now the gap is here to down here. And at this point, the gap is this close to that high or that bear high. At the close of this bar, we have a gap between its low and this bar before this bull breakout. Let's say a trader is using the top of this pullback as the gap. He could also be using the high of this bar. The rally began with this low. The breakout occurred when this bar went above the high of that bar. So either the high of this bar or the high of that bar is the gap that I'm talking about when I'm talking about a potential exhaustion gap. Usually the exhaustion gap bars occur around some kind of resistance, like a measured move up. The bears tried to get a top here, the top failed. You could say the top was here, we got the reversal down, this low below that low. In either case, we have a measured move up in this general area. When you see this series of bull bars late in a bull trend, you don't know if it's going to be a measuring gap leading to a measured move up, the start of an even stronger bull trend. Here, a bull trend with a lot of overlap and pullbacks. Here, a bull trend with no overlap and no pullbacks. Is it going to be the start of an even stronger bull trend, or is it an exhaustive end of the trend? Is it simply a buy vacuum test of resistance? We don't see the bars to the left, but if this is in a trading range, if there are other bars up here, then this is probably a second leg trap. I'll talk about second leg traps in the videos on trading ranges. A second leg trap in a trading range is you have a leg up, a pullback, and a second even stronger leg up. It's a breakout, and it looks like the start of a new trend, but it's still in the trading range, and it traps bulls into buying high. In a trading range, it's better to sell high, not buy high. Therefore, when you see a strong breakout near the top of a trading range, it's probably a second leg trap. The breakout is probably going to be an exhaustion gap. The gaps will probably close. The market's probably going to sell off and close those gaps. At the close of this bar, we have a gap between this low and that high. Here, we have a gap between this low and this high. The gap is still open. The bulls are hoping this is a pullback that leads to a bull trend. The bears are hoping that this is enough selling pressure, 5 bars without a bull body, so that we get a lower high and a second leg down, which we did. And as soon as the market drops below these 2 highs, as it did here, these 3 bars then become exhaustion gap bars. And the final gap, this close and that high, or this pullback low and that high, or at this point now the gap is this low, the pullback low, and the breakout point high. All of the gaps ultimately closed here. Once you have this rally, this is what remains of the gap, the bottom of the pullback to the top of the breakout point, and this became the exhaustion gap. These are exhaustion gap bars once the market closes all of the gaps. A breakout pullback gap. The bulls are hoping this is just a test of the breakout point and the start of a second leg up. It turned out to form a lower high major trend reversal. Once the gap closes, traders are looking for a test of the bottom of the buy climax, possibly even a bottom of the bull trend all the way down here. The bears are looking for a reversal that closes the gap, which it did, and has 2 legs, which it did, 1 pullback 2, and about 10 or more bars down, which it did. So the bears achieved all of their goals. They closed the gap. They fell below the bottom of the buy climax. They got a 10-bar 2-legged correction. Next, they want to measure move down from here to the buy climax low down here. We don't know if that happened later. Again, 2-legged trap, a rally, pullback, and then an even stronger rally, a breakout. Bulls were hoping for a measured move up. The bears got an exhaustion gap. It traps traders into buying the top of the second leg up. First leg up, weak rally. Second leg up, very strong rally, breakout. A bull trend lasting 20 or more bars. And now we have the biggest bull bar in the entire bull trend, certainly the biggest bull bar in the most recent 20 bars. It's more likely going to be an exhaustion gap than a measuring gap, because that's what happens. When you have the biggest bull bar late in a bull trend, it's more likely to be an exhaustive end of the trend than the start of an even stronger trend. About half the time, you get one more small leg up before you get a reversal. A big bear bar, that's a big problem for the bulls. They wanted consecutive big bull bars. Instead, they get a big bear bar. At this point, at the close of this big bear bar, closing near its low, there's at least a 50-50 chance the gap is going to close. At this point here, the gap is this close to the breakout point here or here. And once we get the reversal down here, the gap is now this low and these highs. At this point, it's this low and these highs. At this point, the gap is now this low and these highs. And ultimately, the gap completely closed. And therefore, all of these gaps were exhaustion gaps. This big bull bar was an exhaustion gap bar. Exhausted bulls failing to break above the top of a bull channel. The market tested down to the bottom of the buy climax, which is typical. It usually does that. At that point, the bulls want a double bottom with this low and the pullback low and a resumption of the bull trend. And the bears want a break below the buy climax bar and a measured move down. A bull trend, this bull bar is the biggest bull body in at least 20 bars in the bull trend. In fact, it looks like the biggest bull bar in the entire bull trend. Sometimes you get a series of bull bars, 2, 3, 4 bull bars, and they form an exhaustive breakout at the end of the trend. For me, I would call this single big bull bar the possible exhaustion gap bar, but the breakout itself is 3 bars. These 2 bull bars are not particularly big, and therefore I don't really look at them as part of the exhaustive move. They're part of the final breakout, and within that final breakout there's a big bar. This is the bar that I'm looking at as a possible exhaustion gap. A couple points I want to make about this bar. First, it's the biggest bull bar in the bull trend, but it's not especially big. It's not climactic. It's not big enough so that you know people are buying in a panic. However, it's still a probable exhaustion bar. In addition, it has a big tail on its top. So this is not a climactic panic buy. And because you don't have a huge bull bar, you do not have a lot of bulls trapped into buying high. That lack of extreme buying reduces the chances of a huge bear trend. However, whenever you see an exhaustion bar at the end of a bull trend, you got to be thinking the odds are the bull trend is going to end and the bulls will wait for 10 bars and 2 legs before buying again, and the bears might get a major reversal. It's a big bar. Every big bull body is a breakout, a spike, but it's also a buy climax. The bulls are hoping this gap between this low and this high, between this close and this high, will lead to a measured move up from here to here and then way up on the screen. More likely, the gap is going to close and become an exhaustion gap, and this bar will therefore be an exhaustion gap bar. Here we got bad follow through. The gap closed. We fell below the breakout point right here. And at this point, this is an exhaustion gap bar, and the bears got a reversal down. It also fell below the bottom of the buy climax and fell for about a measured move down from the top of the buy climax to the bottom of the buy climax. And here's a measured move down. We have a bear trend. It lasted 10 or more bars. And now we get a very big bear bar closing below this low. Therefore, this is a breakout point. And at this point, we have a gap between its close and that low, and a gap between this close and this low. As long as the market does not pull back above this low, this is still a breakout bar, and it potentially could lead to a couple legs down. As long as the market does not rally above this breakout point, there's a potential for a measured move down from this high to this low, and then measured move down. The bears are hoping for an even stronger leg down. The bulls are hoping that the biggest bear body, 10 or 20 bars into a bear trend, is going to be an exhaustive move, and that the bear trend will end and become either a trading range or reverse into a bull trend. This bar is extremely big relative to the other bars, closing on its low. The odds are two things. It'll have at least a small second leg down, which it did, and that it will be an exhaustion bar, and that the gap will close. The market will get above this low and probably up to this high and possibly higher. Once we've had this bull bar and the reversal down, the gap is then between this low and that high. If the market gets above this low, the gap closes and this bar then becomes an exhaustion gap bar. If it does get above this low, it's probably going to get up to or just above this high, and possibly the market could rally for a measured move up based upon the height of this final leg down. The bulls want a double bottom, neckline, measured move up. The bears are still hoping that we are going to keep the gap open and that we just go lower and lower. The bulls obviously won. The bears were hoping this is a bear flag and the start of a big bear trend. The odds were, after such a big bear bar, we were going to get at least a small second leg down, but look at the follow through. And now we have 4 bars, 5 bars without a bull body. It looks like the market's always in long and we're going up to at least this high, maybe a breakout above the neckline of this double bottom. The bulls were able to turn this bar into an exhaustion gap bar by rallying above the low of the breakout point here. But we don't yet know if they're going to get 10 bars, 2 legs up. Right now they have 1 leg up. It's a strong enough leg up. The odds are the bars that we do not see to the right will be higher than this. Chances are we're going to get a pullback and a second leg up, maybe a bull trend. We have a bear trend. This is the euro versus the dollar, 5-minute chart. And this is the biggest bear bar occurring 30 or 40 or 50 bars into a bear trend. It's a big enough bar so that the odds are we'll get at least a small second leg down. However, whenever you have the biggest bear bar occurring late in a bear trend, 60% chance it's going to be an exhaustive end of the trend, maybe after 1 more leg down. 40% chance it's going to be the start of an even stronger swing down. For example, a measuring gap. We have a double top here, neckline here, possible measured move down. A lot depends on what the follow-through looks like. If the bears have a second big bear bar, they probably, better than 50%, will get a measured move down from this double top, or this double top, or you can call it a triangle. 3 pushes up, 1, 2, 3, in a trading range. At the close of this bar, we have a gap between this close and the low of the prior bar, this close and this breakout point, and it looks like there's even a gap between this close and that breakout point. Weak follow through, a big doji, the market reversed up. Although you cannot see it, this is the bottom of a channel, maybe a wedge bottom. And I said this bar was strong enough so that the odds were we would get at least a small second leg down. Well, the small second leg down might be this doji. We went down here, we went up, we went down here, and then up. So this doji might be all that the bears get, and this could be the end of the bear trend and the start of a reversal up to close all of the gaps below this low, below that low, below this low, and most importantly, below that low. This is the end of the session, and the gap remained open. Four consecutive bear bars, three of them big enough to be part of a breakout. The biggest breakout occurring late in a bear trend, 20 or more bars into a bear trend, more likely an exhaustive end of the trend than the start of an even stronger bear trend. This is possibly a final bear flag, a trading range late in a bear trend. The market might fall for about a measured move, which it has done already. Strong enough series of bear bars, probably at least a small second leg down, but if the follow through is bad, then probably an exhaustive end of the trend. Three-bar bear breakout, three decent bear trend bars closing around their lows, and now we have even the biggest bear bar of them all occurring 20 or more bars into a bear trend. We're also at a measured move target based upon this double top, this high, that high, neckline, and around a measured move down based upon the height of the entire trading range. Lots of ways to draw the gap between the close of this bar and the close of the prior bar or any prior bar. This close and this breakout point, this is a breakout, so this is, for me, the most important gap. If it gets above this breakout point, then I would say this series of bear bars is an exhaustion gap. Breakout point here, breakout point here. Biggest breakout occurring late in a bear trend, more likely an exhaustive sell climax and the end of the trend rather than a measuring gap and the start of an even stronger bear trend. When I say the end of a trend, an exhaustive sell climax, that means a pause in the trend. The market can go sideways or up for 10 bars, a couple legs. The bear trend might resume later on, but it's ending for probably 2 legs up, 10 bars up approximately. Even though this was strong enough to get a second leg down, it really did not get one. Some traders would say this is the second leg down and it's just a 1-bar resumption of the bear trend. Clearly have trapped bears who sold this close, trapped by this bull bar. This low never fell below that close, so the bears were trapped. They could never get out without a loss. Once the rally went above this breakout point, the highest breakout point, I would say this breakout is an exhaustive end of the trend instead of the start of an even stronger trend. And at that point, you could call all of the gaps exhaustion gaps. I would call this bar an exhaustion gap bar. I would call these 3 bear bars an exhaustive sell climax. The bulls have at least 10 bars up. They get above the top of the sell climax and above the top of the final bear leg, but they only have 1 leg up. It's big enough of a rally so that if we do sell off, the market will probably come back up to this high at some point later on. Because the bears were never able to get out here, chances are the market's going to test back down here, and this whole thing will become a trading range. I don't have enough bars to the right to show that. At this point, chances are we're going to test down here, and after we do, chances are we're going to get a second leg sideways to up. So either we're going to go up here and get a second leg, or we're going to come down here and test back up and get a second sideways leg. It rallied above the final breakout point and therefore an exhaustive sell climax, and this became an exhaustion gap bar. Went above the top of the sell climax. The bears want a double top, break below the neckline, measure, move down. This is too much of big down, big up, big confusion. It's more likely the market's going to enter a trading range, test down, and then test back up. I began by talking about moving average gap bars. In a bull trend, the bars are usually mostly above the moving average. If a bull trend goes on 20 or more bars and there's finally a bar completely below the moving average, there's then a gap between its high and the moving average. Sometimes you'll get several gap bars. The rally usually resumes. However, once it does, 60% chance the bears will get an attempt at a major trend reversal. Once they do, 40% chance they'll get a swing down. And the opposite's true in a bear trend. If you finally get a bar completely above the moving average, that bar is a moving average gap bar. 60% chance you'll get an attempt at a major trend reversal after a resumption of the bear trend. And like all major trend reversals, you'll have a 40% chance of a swing up. 60% chance the reversal up will lead either to a bear flag or to a trading range. Exhaustion gaps. Whenever you have the biggest trend bar occurring 20 or more bars into a trend, it's more likely to be an exhaustive end of the trend than the start of an even stronger leg of the trend. Traders look for a closure of the gap and then either a trading range and then a resumption of the trend or a reversal of the trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on gaps. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on gaps. I'm going to begin by talking about micro gaps. These are very small gaps that most traders do not even realize exist. One type of a micro gap is a gap open bar, where the open of a bar is above or below the close of the prior bar. And that often is an indication of what the market is trying to do. And I want to make the point that gaps mean strength. Every trend bar is a breakout. It's also a climax, it's also a spike, but every trend bar is an attempt to break out, and therefore it is a gap. We have a trading range. Most breakout attempts fail. Therefore, if you have trend bars up near the top or bear trend bars near the bottom, the breakout attempts will probably fail. Most of the time, when you get gaps, they don't have any predictive value because there's no follow through and the market reverses and it continues to do what it has been doing. Here's a subtle gap. Look at the low of this bar and the high of the prior bar. We have a bull trend bar, so it's a breakout. Therefore, I'm always paying attention to what the next bar does. Will its low stay above all the bars to the left? Will its low stay above the high of the bar immediately before the breakout bar? And if it does, like here, this low is above this high, there's a gap. And that's a sign of strong bulls. They're buying above support, the breakout point, and that increases the chances that we're going to get higher prices. And this is what followed. Anytime I see a trend bar, I look at the bar before and the bar after. If they do not overlap, there's a gap, and the odds of follow through in the direction of the trend bar are greater. We have a bear trend bar. I look at the high of the bar after and the low of the bar before. If there's no overlap, there's a gap. That increases the chances that we're going at least a little bit lower. We have a series of bull bars. I look at the bull bar here and I look at the low of the bar after and the high of the bar before. There's a gap. That increases the chances that the market's going at least a little higher. And here's another gap, a big bull trend bar. Therefore, I look at the low of the bar after and the high of the bar before. If there's a gap, it increases the chances that the market's going at least a little bit higher. gaps are a sign of strength. In a bear trend, a gap down, a sign of selling pressure. In a bull trend, gap up is a sign of buying pressure. Take a look at here. The low of this bar, we have a gap above this high, and we have another gap here. The low of this bar is at or above the high of this bar, and therefore it's a gap. But then the market traded below that high, and the market traded below this high. The bulls are getting gaps, but the gaps are closing. At this point, we have a gap between this close and the high of that bar, and the gap closed on the next bar. And the same thing here, a gap between the close of this bull bar and the high of the prior bar, but the gap closed on the next bar. We're getting gaps that are closing, and therefore the bulls are not as strong as they once were, and it reduces the chances that we're going higher. Pullbacks falling below breakout points. We have a bull trend bar, so a breakout. The high of any of the prior bars is the breakout point, but the gap closed. The pullback fell below the breakout point. That is a sign that the bulls are not nearly as strong as they could be. When gaps start to close in a bull trend, it reduces the chances that the market is going higher, and it increases the chances that it might go lower. And now we're getting bear trend bars. Here we have a bear trend bar. So I look at the high of the bar after and the low of the bar before, and if there's a gap, it increases the chances we're going lower. Another big bear bar. I look at the low of the bar before, the breakout point, and then the high of the bar after. We have a gap. We tried to close the gap here, but this pullback did not close the gap. The bear trend resumed. The open gap here increases the chances that we're going to go at least a little bit lower. In this particular case, we went a lot lower. 5-minute chart of the euro versus the dollar. A big bear bar, and therefore I look at the low of the bar before, a potential breakout point, and I look at the high of the bar after, a pullback. And here the gap closed. Another big bear bar. I look at the high of the bar after, the low of the bar before, the gap is open. And then we have another gap here, this close and that low, but this gap closed on this bar. It went above that low. The gap between these lows and now this pullback is still open, good for the bears, and they got a second leg down, but we reversed up, and ultimately this gap closed. A big bear bar, you're going to be thinking that we might be trying to form gaps. The close of this bear bar, there's a gap between this close and that low, but the gap closed over here. It was a bear trend, but now we're getting gaps that are closing. Bear trend bars, but every time the bears are failing to get a gap. Look at the close of this bar. It could not even close below the low of this bar, so it could not even form a gap. The market's becoming increasingly neutral. The bears are becoming weaker. The bulls are becoming stronger. And we ended up getting a swing up. Every time you get a bull trend bar, you look at the high of the bar before, the low of the bar after. If the gap stays open, it increases the chances we're going a little bit higher. Then we have a series of bars that have gaps. We have a small bull bar. Look at the low of the bar after, the high of the bar before, the gap stayed open. A gap here, this low, that high. This bull trend bar is a gap bar. Another gap bar here. The pullback stayed above the breakout point. Another breakout here. Pullback stayed above this breakout point and went a little bit below this bar, just a little. When that happens and it just goes a little bit below, I still call it a gap, but I call it a negative gap. I'll talk more about that later. It's still a sign of strength, but it's not as strong a bull trend as over here where the gaps are staying open. A lot of gaps on the way up increases the chances that the market's going to go higher. If the open of a bar is above or below the close of the prior bar, I call it a gap open bar. Look at this open and that close. They're at the same price. There's no gap. Here's the close of this bar, and the open of that following bar is exactly at the same price. No gap. This bar opened above that close. There's a gap. This bar opened below that close. There's a gap. So bull bar and then a gap down that rallied up, a bull bar and a gap up that rallied up. We have a bull bar and another bull bar. The bull trend is continuing. Open of the second bar above the close of the first bar. And here we got continuation up, but we had a gap down. Instead of continuation up, bull bar, bull bar, bull bar, bull bar, we have bull bar, bear bar, bull bar, bear bar. Here we have a gap down. The open of this bar gapped below the close. Here we have a gap up and a reversal down. This bar opened above that close and it reversed down. I'm mentioning these gap bars here, continuation up, here bull trend, reversal down, because they can tell you important information about how strong a breakout is. And if you're getting reversals, you may get lower prices. If you're getting continuation, you're probably going to get higher prices. This is very helpful to scalpers. I pay attention to these gaps because they give me a variety of scalp setups. I talk about that in the videos on scalping. The open of the bar gapped below the prior bar. That's a gap open bar. These are all gap open bars. The open of the bar is not at the same price as the close of the prior bar. So these four bars, 1, 2, 3, 4, all had a gap open. Gap up and gap down, both resumed up. Gap down and gap up, both reversed down. Instead of the first bar being a bull bar, here the first bar is a bear bar. Here's the close of the bar, and we gapped up. We're reversing up. Here we gapped down and we reversed up. In this case, we gapped down and we continued down. We gapped up. This open is above the close of that bar, and we continued down. Two reversal setups with a gap up and a gap down. Two continuation setups with a gap down and a gap up. Again, I pay attention to things like this because there are all kinds of little scalps that I can take based upon what these little gaps are telling me. Do I think the market is going to continue up? Do I think it's going to reverse? If I think it's going to continue up, I'm looking to buy for a scalp. If I see a reversal up with gaps, then I'll be looking for some kind of a buy or maybe a test down to the gap. If I see a continuation down, I'm looking for lower prices and I'm looking to sell. Gap open bars, all four bars opened with a gap compared to the close of the bar before. Gap open bar, gap open bar. The euro versus the dollar, 60-minute chart. The open of this bar is below the close of that bar. We have 3 consecutive bear bars. Strong selling. What does that tell you? Why did this bar open below the close of that bar? Because a lot of traders, once they saw 3 consecutive bear bars, decided the market was going lower and they sold the close. As soon as this bear bar closed, a lot of traders hit the button to sell the market. And the result was there were so many traders selling at the close of this bar. This bar opened below. And that tells you that there were a lot of traders trying to sell as soon as this bar closed. That increases the chances that the market's going lower. Same thing here. this open below that close, it tells you that a lot of traders sold at the market as soon as this bar closed, and therefore the market was likely to go at least a little bit lower. Ultimately, it went a lot lower. A pair of very strong bear bars, but look what happened here. We have a gap up and a bull bar. Traders who saw this bear close thought that maybe we're forming a higher low major trend reversal. Head and shoulders bottom, left shoulder, head, right shoulder. And they thought this might be a last attempt by the bears to continue the bear trend. What happened here is so many traders decided that this was a bear trap, a sell vacuum test of support at the top of this bull buy signal bar, that instead of selling the close, they bought the close. You have two strong bear bars, and the next bar opened above that close. That tells you that there were a lot of traders, as soon as they saw this bear close, thought it was a bear trap, trapping traders into selling low, and they thought the market was going to reverse, and therefore they bought. As soon as this bar closed, they hit buy the market, and this bar opened above that close. When you see that open above the close and the context is good for a potential reversal, traders are going to either buy as soon as that bar closes or as soon as it starts to reverse up. Something's wrong with the bears if we have a potential for a major trend reversal up and we have consecutive bear bars followed by a gap up. That is not good for the bears. It increases the chances that a whole bunch of traders are buying at the market even when they see consecutive bear bars. Why would a whole bunch of traders buy at the market when there are consecutive bear bars? Because they think it's a bear trap. It's a test down and that the market actually wants to go higher. Now we have a buy the close bull trend. Look at the open of this bar and the close of that bar. Why is this open above that close? Because so many traders thought the market was going higher. As soon as they saw this close, they hit buy the market. Why is this open above that close or this open above that close? Because as soon as traders saw the bull close, they thought the market was going higher. Everybody hit buy the market. And so many buy orders, the market opened above that close. So a buy the close bull trend with gaps up, the market's probably going at least a little bit higher. If you're looking to swing trade, you can buy, and bull scalpers will buy as well, confident that the probability is high that the market's going to go at least a little bit higher. This is a euro versus the dollar chart, and the gap open bars are not as common or as useful in Forex markets, but they're very useful for traders trading stocks and the E-mini. A gap means strength. We have a breakout and therefore a potential gap. This close and any of these highs. We're reversing down, and therefore there's a gap between this low and the bars to the left. And now we're resuming up. The bottom of this pullback tested the top of this bear bar. It overlapped a little bit with this bull bar high. It did not get down to the top of this bull bar. Therefore, slight negative gap with this high, a perfect breakout test with this bear bar high, and an open gap with the highs of these three bars. And then a bull bar after the breakout. This is probably a bull flag. The market probably is going at least a little bit higher, which it did. Every trend bar is a breakout. Every trend bar is a buy climax. Every trend bar is a gap. There's a gap between this close and that low. And then once we start to go sideways, there's a gap between the low of the pullback at this point and here. And here we're starting to bounce up. We still have an open gap from this low to that high. And again, an open gap. The bears are unable to get below the breakout point. The pullback is staying above the breakout point. This could lead to a measured move up. We have a double bottom pullback testing a breakout point. Even though it's a bear bar, traders will buy above it, or they'll buy above the bull bar, looking for a second leg up and maybe a measured move up. Whenever you get a bull trend resuming, especially when there's a double bottom test of a breakout point and the gap stays open, chances are 60% or higher that we're going up for some kind of a measured move. Bull trend resuming, not particularly strong, lots of dojis, lots of overlap, lots of bear bars, but still always in long. And look what happened when the market reached a measured move based upon this gap. The bottom of the bull trend, the gap, possibly the middle of the bull trend. When it reached the measured move target, it sold off. That means bulls sold to take profits, and some bears sold for a scalp, looking at this rally as not very strong, plus pretty good selling pressure here and here. Therefore, they thought there might be enough profit taking on the part of the bulls for the bears to make money if they sold with the limit order at that high, looking for a scalp. Bull trend continued up, fairly tight channel. We have another big bull bar and potential gap between its close and this high, its close and that high, and the low of any pullback bar and maybe a prior high like this. The bears are hoping this is an exhaustive end of the move. The bulls are hoping that it's a breakout and part of a small pullback bull trend, a bull trend that constantly looks weak, yet forms gaps and continues up for many more bars. When you look at a breakout like this, you have a potential measuring gap. There are several choices for the bottom of the measured move. For example, this higher low to that gap could lead to a measured move up. This low, maybe even that low, breakout point, possibly measured move up. Computers will look at all possibilities. If the market goes above the nearest one, they'll then see what the market does when it reaches the next one. Possibly a measured move up from this low to a gap if this gap stays open, or this low to the gap, or this low to the gap. And you can see what happened when the market reached the measured move based upon this low and went above the measured move based upon this low to the gap. However, it stalled when it reached the measured move from this low to the gap. You can see the bears tried to reverse. They tried to turn this into an exhaustion bar. Instead, the gap stayed open above this breakout point. This became a measuring gap, and the market stalled at a measured move up from this low to the gap up here. Bulls were taking profits. Aggressive bears might have scalped up here. Small pullback bull trend, usually better not to sell, usually better only to look to buy until the market turns into something else, like a trading range. Then traders might sell at prior highs looking for a scalp down. Micro gaps are just very small gaps, and they come in many different types. The close of a bar and prior highs or lows. If they stay open, they are a sign of strength, and they increase the chances that the trend will continue. If the current bar opens above or below the close of the prior bar, I call it a gap open bar. And scalpers will pay attention to gap open bars because they can often take small scalps, either betting on a reversal or a continuation. Gaps mean strength. If gaps are staying open, chances are the trend will continue at least a little bit further. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on gaps. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on gaps. Gaps very often lead to trends if the context is right. However, if gaps are closing in a trend, it's a stair pattern, and it's usually a sign that the channel is soon going to evolve into a trading range. This is the euro versus the dollar 5-minute chart. Every bear trend bar is also a breakout and a potential climax. Here we have continuation after the bear bar and a pullback that did not overlap the low of this bar. This is a breakout point. This is a breakout pullback, a test of the breakout point, and it looks like the bear trend might be resuming. Even though you have a lot of small bars and doji bars, it's still a potential sign of strength. If the market starts to form a series of gap bars like this, it usually means the bears are strong, and it increases the chances that the market will fall a lot further. We have another bear trend bar, so a gap between this close and that low, a gap between this close and any low, and then the bar after has a bear body that increases the chances that we're going lower. Also, the high of this follow-through bar did not get above the breakout point, and therefore it's another potential gap if the market goes lower and does not go above this breakout point. It increases the chances that this gap between this high and that low could lead to a measured move down. Top of the bear trend, measuring gap, measured move down. The bears look at these gaps. We have a gap here and a gap here. The bears look at the gaps as a sign of strength, and they're hoping that we're getting a small pullback bear trend. And if so, it could last a long time. If you have a bear trend that lacks consecutive big bear trend bars, in other words, it does not look very strong, it looks like it might be a bear leg in a trading range, but it's forming 2 or 3 gaps, gap, gap, you got to be thinking it could be a small pullback bear trend, which is one of the strongest types of bear trends, and it can last a long time. And you can see we got vacuumed down in a sell climax to the measured move target based upon the top of the bear trend to this gap. This is the biggest bear bar occurring late in a bear trend, and therefore there's an increased chance of it being an exhaustive end of the trend. However, it's occurring in a small pullback bear trend. A gap here, a gap here, a very tight bear channel. This is more likely going to be a measuring gap. The bulls got a bull follow-through bar, so possibly a reversal up, and this will be an exhaustive end of the trend. But when the channel is as tight as this, and it's a small pullback bear trend, 1 bar pullback, 1 bar pullback, it's more likely that we're going at least a little bit lower, and possibly this could be a measuring gap, and we could fall for a measure move down. This is not a good buy. This is not a good bet on an exhaustion gap. It's a possible exhaustion gap, a possible failed breakout, but it's better not to buy until after you see a strong reversal up, because the bear channel is so tight. Any reversal here is probably minor, which means a bear flag, maybe a trading range. This bull bar and this tail, in part, is caused by bears taking profits at the measured move target. However, a lot of bears are betting this is a small pullback bear trend, and they're going to sell any reversal. Here, the market could reverse up only for 3 small bars. Here, only 1 bar. Here, only 1 bar. Chances are, if we try to reverse here, bears will sell any small pullback, and the bear trend will resume. At the moment, we have another potential gap, the high of this pullback bar and the low of this breakout point. It could lead to a measured move down. Again, whenever a channel is extremely tight and the pullbacks are small and brief, even if you get an exhaustive bar like this, it's still more likely to lead to a measured move down than it is to lead to a reversal. You have to be looking to sell. Gap between the high of the pullback and the low of the breakout point. Getting follow through, but it's still a small pullback bear trend. The pullbacks are small. The sell-off does not look strong. It lacks consecutive big bear trend bars, but these gaps are a warning that this could last a long time. Bulls could not close the gap despite that bull bar. This bigger bear bar is a sign that a lot of the bulls betting on an exhaustion gap are selling out with a loss. The bulls are giving up. And if the bulls give up, we're probably going to go lower before they'll buy again. The bear trend lasted through the end of the session. And this looks like it's probably a measuring gap from the top of the bull trend, middle of this gap, down to the end of the session. And in fact, it was a measuring gap. And at the end of the session, the bears took profits. Not enough time left for the bulls to make any money buying. Also, it's still a small pullback bear trend, not worth buying. Would bulls buy for a scalp? I would not. We're starting to get a lot of small bars, starting to enter a tight trading range. At the end of the US session, dead money. The chance of a profitable buy is small. But the bears are buying to buy back their shorts at the end of the session. Bear trend, we have a series of gaps, this high, that low, this pullback, that breakout point, these pullbacks, that low, this high, that low. Even though these bars went above this low, they did not go above the low of the bar before the bear breakout. Therefore, it's still a sign of strength. Not as good a sign of strength as these other gaps where there's no overlap, but still a sign of strength. And as long as the market is forming a series of gaps, it's better to only look to sell. If you looked at a slightly higher time frame, this would simply be a series of big bear bars and there would be no pullbacks. This is still a very tight bear channel and therefore a breakout on the next higher time frame. And if the market's in a breakout phase, traders should not be looking to buy. You should only sell for any reason. When you see a lot of open gaps, 2, 3, 4 gaps, you cannot buy. You can only sell. I've been talking about gaps that stay open. Now I'm going to talk about stairs. And by stairs, I mean gaps that close. The gap is open here. We have a triangle. We went up, we went down, we went up, we went down, we went up in a tight trading range. Higher lows, lower highs. Traders pay attention to this. We have a gap, maybe an exhaustive end of the trend, maybe a measuring gap. Well, at this point, we know the gap closed. That tells you that the bulls are getting pretty strong. Big down, big up. Unlikely to go from a tight bear channel into a bull trend, but it might start to transition either into a broad bear channel or a trading range. It's a sign of strong bulls. Because the bulls are getting stronger, unlike a tight bear channel where you should never buy, bulls will buy at and below prior lows. We closed the gap. We had a gap between this low and these pullback attempts, and then the gap closed. It's around a 50% pullback of the most recent bear leg, so bears will sell strong bull closes in the middle of the most recent bear leg, betting that any reversal up from a tight bear channel will be minor and not a bull trend. By minor, it'll either become a bear flag or a trading range. In either case, if they sell and sell more higher, they should be able to make money. The key point on this slide is we have a closed gap, and therefore, if the bear trend continues, we're in a stairs pattern where gaps close. If gaps are closing, bulls know if they buy at a new low or lower, the market will rally back above the breakout point and they can make money. Bulls hoping for a major reversal? There is no major reversal. It's not a clear wedge bottom. It's not a major trend reversal. It's a minor reversal. It's a strong minor reversal in a tight bear channel, but it's still a minor reversal, and that means the odds are it'll either be part of a trading range or a bear flag leading to a resumption of the bear trend. Bulls are buying here, not up here. Everybody's going to be selling here. Bulls will sell to take profits, and bears will sell 50% pullback, betting it's a minor reversal and that the bear trend will continue, or that it'll be a trading range and will test down near the bottom. Terrible follow through for the bulls hoping for a major reversal. Bears will sell below this bear bar. Bulls will sell out of longs below this bull bar. But we have a closed gap, this low and this low. We close the gap. Therefore, bulls expect that if we go to a new low, we'll come back above the breakout point. So bulls will start buying new lows and scaling in lower, betting that they can make money scalping again here. Bulls are not going to buy up here at the top of a minor reversal. However, a strong enough minor reversal so that bulls are expecting the bear trend now, instead of being in a tight bear channel, to be in a broader bear channel, a stairs pattern, and they'll buy at a prior low and add on more lower, looking for at least a scalp. Breakout, pullback. Breakout, pullback above the breakout point. Broke below that low, pullback above the low. Gaps are closing. Therefore, it's a stairs pattern. The gaps are not staying open. The bear trend is not as strong, and bulls will start to buy for scalps at and below prior lows. They're willing to buy. If it goes down more, they'll buy more lower. They'll scale in. And bears are no longer selling breakouts. It broke to a new low. Instead of the bears selling, the bears are buying. The bears now have switched. Instead of selling at any time, including a breakout below a prior low, the bears are switching. Now they're selling with limit orders above bars, betting that we're now in a channel phase. The bulls who bought this low, it probably bounced far enough up for them to make a scalp. The same here, maybe they made a scalp. The bulls who bought at this low with a limit order made a scalp. If bulls are making money in a bear trend, there's something wrong with the bear trend. Usually it's a sign that the bear trend is going to soon transition into a trading range or possibly even into a bull trend. This is a high 4 buy setup, high 1, high 2, bear breakout, and then high 1, high 2. So high 1, high 2, high 3, high 4. Consecutive bottom attempts. We tried to get a high 2 buy here. It failed. Strong enough breakout for at least a second leg down, which we got. And now we have another double bottom attempt, consecutive bottoms. Bottom attempt here, failed with 4 strong bear bars. And then we got a second leg down. Now we have a double bottom attempt here. Higher probability that we're going to get 10 bars, 2 legs sideways to up. And in fact, we got a lot of bars up, 40 or 50 bars up. On the way up, look at this, a bear bar, but its low stayed above the high of a prior bar. Here we have a bear reversal attempt, but the low stayed above that high. And the same with over here. Maybe this overlapped a little bit here, I can't tell. So it's either still a gap or a negative gap, a sign of strong bulls. And gaps, this trend is probably going higher. When the bears cannot make money selling at and above prior highs, then only the bulls are making money. Traders can buy, and they should buy for any reason. Gaps, if they stay open, often lead to trends, especially, for example, if you're getting gaps in a bull trend and the pullbacks are all small. Even if the trend looks weak, it could be a small pullback bull trend and last a long time. Therefore, whenever you see a weak-looking trend, but there are gaps in it, the trend might last a lot longer than what you think. On the other hand, if you have a stairs pattern, if all the gaps are closing, traders will start to scalp against the trend. For example, if you have a bear trend and you have a gap and then it closes in the next bar or the next few bars, bears are buying back their shorts at new lows. They are not confident that the trend is going to continue much longer, and bulls are buying at and below prior lows. If the bulls can start to make money in a bear trend buying a breakout to new low, the bear trend is probably not going to last much longer. Stairs patterns are a sign that a trend is weakening and probably transitioning into a trading range and possibly an opposite trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on gaps.